Prop firms and traders are in the business of making money. All prop firms need to learn how to manage risk with liquidity providers, software vendors, and profitable traders and losing traders so they don't go bankrupt. Today I'm going to share some basic risk management techniques used by Forex prop firms. Hey, it's Frank Nagy, and welcome to my channel where we help financial entrepreneurs grow their business in the financial markets. If you're new here, subscribe to my channel and hit that like button. Because the prop firm's money, in most cases, is always on the side of the liquidity provider, we can say that the relationship between the prop firm and its traders are generally unequal, and the liquidity problem stems from this imbalance. If a liquidity provider wants to profit more and they widen the spread slightly, the solution for the traders will deteriorate. Furthermore, with complete reliance on one provider, any issues on their end, whether financial or technical, will be extended to the prop firm. Also, keep in mind that switching liquidity provider brokerages is a lengthy process that can take up to 3 months or more. Hiring an experienced prop firm consultant like Frank Nagy Financial Services will help greatly reduce the burden of setting up your prop firm by helping you choose the right liquidity provider. Not all prop firms have the funding necessary to have a sizable workforce of developers and technological experts. Contractors who create additional back office functions such as client resource management systems or CRMs, connections to payment systems, bridges, and other provider services are frequently used by prop firms. When you grow technologically reliant on one particular software provider, you will find it very challenging to switch service providers in the future. When selecting a back office software provider, it is important to exercise the utmost caution and to scrutinize the sales manager's statements. Additionally, prior to execution of the agreements, any prospective modifications to the design and ideas must be tested. All traders come to prop firms with the intention of making money, obviously. The challenge is how to manage performing traders in a way that prevents the prop firm from going out of business as a result of rapid, unforeseen market changes. One method of risk management used by prop firms is to establish an A and B book accounts. Through its liquidity brokerage provider, Forex prop firms have the choice of sending lucrative trades to an A book and then get sent to the open market. Then the prop firm and the trader are on the same side of the trade. When traders make money, the prop firm makes money. When the traders lose money, you get the picture. Risk management for the A book must be carefully monitored to ensure that the firm does not get a margin call in the event of a major drawdown. By setting preset percentage drawdowns for the traders, the prop firm can limit itself from going beyond the loss threshold. There are other creative risk strategies which can be implemented, and by hiring a firm like Frank Nagy Financial Services can help choose which risk analysis strategy would be best. A liquidity provider may also offer a B-book system. For traders with a poor track record should be placed in the B-book system. And this simply means that their orders will not go to the open market but will be warehoused with the liquidity provider. In this scenario, traders can experience a drawdown without exposing the prop firm's margin account. This will reduce the execution quality for the prop business when they observe a plainly toxic trade flow. Traders may experience frequent slippages because of this, and it's essential to assess the flow of trades and create a specific handling procedures for profitable clients to prevent this from happening. On the flip side, any profitable traders will come at the cost of the prop firm. If the risk manager takes a balanced and analytical approach to evaluating trades and applying good risk model, will be a good tool for any prop firm. A good risk manager should be able to tell the difference between a consistent strategy and regular gambling. The frequency and volume of trades distinguishes emotional and impulsive trading styles, and such traders are frequently left to the internal execution, such as the B-book. If a systematic pattern is observed, especially one that has previously produced positive results, such trades should be hedged by utilizing the A-book. Expert advisors, or EAs, behavior and profitability are generally predictable for experienced risk managers. Traders that exhibit signs of a strategic approach and manual trade management, on the other hand, are worth considering for long-term hedging because the gain can be unpredictable. Many experienced traders have periods when their strategy's success coincides with the market's phase, and that is with any fundamental changes. Such occurrences should be closely monitored because those trader accounts are the first in line for hedging. By working with a prop firm consultant like Frank Nagy Financial Services, we'll help set up spreadsheets and analytic software which will allow the prop firm to use external liquidity to hedge B-book risks without jeopardizing the relationship with providers. If you're considering starting a prop firm, I recommend downloading my ebook bundle, The Ultimate Prop Firm Guide and The Ultimate Hedge Fund Guide. Click on the link in the description box below.